Of TCS with us. They stunned the investor world yesterday with the announcement of the large, order wins, but equally perhaps disappointed with the revenue not really growing much from from year ago levels. So let me welcome Kritivasan and MGS.
Good morning.
Good morning.
Gentlemen, thank you for this quarterly exercise. Kriti, let me start with you. For me the numbers looked okay, good margins. But suddenly this number of people down to, by 6,300, that was a bit of a shocker. Does it mean you're not expecting enough work? Is that why you actually shrunk your workforce?
Latha, we've been explaining this, during the last few years, we've been hiring a lot and we've been training a lot. And so when you find that there is an uncertainty in demand, then you need to also see how do you optimize the workforce you have. Like Milind was explaining, we continue to hire, we not stopped hiring, but we probably hired less than the number of people that left us. But it's not that a lot of people left us also. If you look at our attrition is also coming down.
Exactly, attrition also came down in spite of the workforce decline.
We have hired so many people in the past. We've been training them continuously on new technologies. So when they're available for us to be deployed in programs, we try to use them, and that's important for us to give them an opportunity to work in projects. So there is no need to hire as many people. So that's where we are.
NGS, on the same issue, is it that those, the new jobs that are doing, we have trained people in AI, is that requiring fewer people? So will we see a falling pace of hiring?
It's too early to comment on that. I think, there is a general perception and as well as the rhetoric. Many reports from analysts alike have talked of about at least 30% improvement in productivity in certain work that we do, right? I think there is a possibility of improving this, but one has to weigh how that pans out eventually in large enterprise scale engagements. The first point. Second is there will always be licensing costs of all the hardware, software that you need to put in some of this. Net there will be some savings, but in any new technology, as people adopt it and embrace it, there will be a huge demand for such talent.
Okay.
Right. So I don't think that the reduction that you are talking about is because of the productivity thing that we are adjusting. As he explained, it is really about we have enough bench, number one. We hired a lot in the few quarters passed by, especially during the great attrition that people talked about. Now we have enough capacity to meet the current demand levels. We on a quarter-on-quarter basis calibrate how many freshers that we will onboard, how many laterals that we onboard. That is somewhat moderated, but doesn't mean that we have stopped hiring.
I just want to add on to what he said in the context of generative AI. While it will bring in productivity, it's also our belief that it will create new opportunities, new product, new services that were not being offered before. So net we believe that there will be more requirement for people with maybe different kind of skills. But overall we believe the gross requirement would continue to be high because there will be new products and new services that will be
all the more reason why reduction in workforce
that is
a little worrying.
Because generative AI is something.
Should I conclude? Can your investors conclude that in the immediate current and next quarter there is not there is likely to be low work?
Current and next quarter, is based on the visibility we have. We hire, as you said, we have enough people on the bench. If you have visibility far beyond, saying that we need to hire more people, train them further, based on the visibility we have, we believe that we have enough people. And we continue to train them and give them opportunity to work in these projects.
So Kriti, based on the visibility, can you say H2 will be better than H1?
Have you ever said that before? Any guidance have you given?
No, it's just that H1 has been flat, right, for you?
See, H2, H2, is traditionally a weaker quarter for us.
But you have strong deal wins, which are executing.
We have strong deal wins, but the ones I talked about before, the programs that are long-standing programs that get optimized, some of them get passed. You cannot predict at what pace that will happen, because some of these programs, if they don't have customers are not cancelling, they're reprioritizing them. If they don't see good ROI, they pass them, or some of them get downsized. So at what that will, the customer's decisions will depend on how they see the market outlook. Okay, so it's very difficult to call, like whether it, yes, logically with all the wins that we have, we should continue to be pouring more on the top of the bucket, as I explained. But what happens at the bottom of the bucket is also based on the economic outlook our customers have.
So we want to understand a little bit more about the bottom of the bucket, and for simplicity, for the sake of simplicity, let's call it the revenue leakage that you are seeing as projects come to an end, or discretionary, projects get paused or, come to an end. The thing is that while it's natural projects come to an end, we've not seen it. This is the first time in 13 quarters that the top line has come down for the company, that the incremental revenue has not been enough for you to offset the loss of revenues that you are seeing from existing projects.
Yeah, that's the nature of the situation we are in, right? We have not seen this kind of economic uncertainty before. When you see economic uncertainty, our customers also act. They look at what is important for them in the immediate term. They take action. So yes, we may not have seen this, but it is not very unnatural, like the way I said.
But will it continue in Q3? Sorry to interrupt. Q3, Q4?
I won't be able to comment to you on that one.
So no sign of discretionary spending coming back?
It is not a question of, again, don't use the word discretionary spending, right? Because most of the work that we are winning today, it is discretionary spending.
Okay.
Okay, it is not a question of discretionary spending. Essentially, what brings in immediate return on investment, that's where if something brings immediate return on investment, that attracts attention, that attracts investment. If something, also during the pandemic period, a lot of tech investments happen. So there is some re-evaluation, all these programs are yielding results. If something is not yielding result, can we take a re-look, pause? So all those decisions are taken.
Let me interrupt in this from a banking reporter's point of view. BFSI is your big sector, and there are multiple injuries for the US financial sector. Not only did interest rates go up, interest rates for longer tenure has gone up, which means lot of mark-to-market losses.
Yeah.
So, for the first time I'm seeing year-on-year terms BFSI is minus 0.5%.
Yes.
Of course, quarter-on-quarter it's better, but year-on-year it's...
Yes.
So, considering that as a banking person I can see more mark-to-market losses, is it going to be worse in Q3? That is genuinely my biggest fear.
See, like I do understand about the mark-to-market losses, but if you look at excepting one or two large banks, in the last quarter, most of the US banks posted good results still. Okay, and it's more my worry is about the sentiments than about what happened now. I was explaining yesterday, the household savings are coming down, even though the spend is still high. In fact, I was reading a report that said credit card outstanding is still at an all-time high, spend is high, but once the household savings starts depleting, you would expect that spend will also come down. Like we are seeing that reflecting in our consumer business, where even the essential business is slowing down. So there are definitely uncertainties, and our customers are taking actions to handle what they see is a potential situation, which is resulting in, as I said, projects that are having immediate ROI getting more attention, and where they don't see the ROI getting less attention.
So chances of Q3 being more difficult than the quarter gone by is something we have to accept.
And I think seasonally it's a weak quarter, number of working days are less.
No, but seasonality apart.
Only seasonality. Second is that, look, given the narration that you talked about for banks, which is typically applicable for many enterprises, their year-end is December, so they would like to shore up their own balance sheet and profits in this particular quarter. So there will be a lot of optimization that will happen during this quarter, and we have to wait and see how much we are able to pull from all the big deals that we are executing. At the same time, how much it gets bought out at the bottom. And then balance it out, but we are hopeful that we will have at least be positive about it rather than being negative about it.
NGS, we never quite got what the tech budget number is for 2023. They were delayed to begin with. There was a lot of uncertainty at the beginning of the year. So now that we look back at this year, can you tell us what has been the tech budget growth, degrowth, or any number for
I think
this year?
it remained stable for,
So flat.
for
Mostly
2023.
flattish,
It remained stable. And now customers are always, now this is the time of the year where they'll recalibrate the budgets for 2024. So,
And will they be on time this time for next year, or do you think it
see,
could be?
given the certainties, I think my own planning horizon is 15 days. Right?
Your planning horizon is 15
days maximum, right? Because a lot of things happen, right? So in every market something happens. The war, nobody thought that this Israel situation will emerge 10 days ago, right? So every 15 days there is something, a new technology comes in, new ways of, someone goes out and talks about AI. So impacts are to be constantly assessed, right? So our planning horizon is about 15 days.
Even our customers, I think we are reading a lot on what is the next year budget. Like even increasingly your customers don't look at as a 1 year horizon. They take a quarter in time and make a decision on where they want. And even if they say there's an increase, it doesn't mean much, because during the quarter if things change, they recalibrate it all the time.
Okay, so calling beyond that point is a little difficult. What about margins, Kriti? I mean, this was a pleasant surprise, and it was perhaps to some extent expected that your margins would improve. But the aspirational 26, do you see yourself at least inching higher in the remaining 2 quarters of the year?
All our efforts will be to inch higher.
Oh, of course. Okay. But what is the visibility?
See, we have taken steps this quarter. We are assuming some of them will yield results in the subsequent quarter also. So, and all our teams are geared up, particularly when you don't have good visibility on the top line. I think it's natural to focus on the bottom line, so that focus will continue.
And here's some deal wins. Your previous deal win guidance was $7 to $9 billion on a quarterly basis. In the press conference yesterday, you said $9 to $10 billion could be the run rate going ahead. So you've stepped it up and you've proved it over the last 3 quarters. What is that driven on? Because it doesn't appear that the market pie has gone up. Are you being more aggressive, and are you okay to sacrifice a little bit of margins to get these long tenure large deals, or are you gaining market share? Can you tell us this $9 to $10 billion of deal wins? What makes you so confident you'll be able to sustain it?
See, in general, our philosophy is growth with margins. If you focus on one of them, you will lose both, right? But having said that, look, there are strategic opportunities like, we need to get into, and then where, on an overall basis it will come. But in the immediate basis, we may be losing out on margins. We will not shy away from such investments. I think we have time and again proved that, right? From our perspective, I think 3 consecutive quarters of $10 billion plus in order book is very good for us. Like the argument that we had a little earlier in terms of are we having enough deals to replenish what's going out in the bottom, means that, look, we'll have to go and pick up more deals, so that we can meaningfully address that growth challenge that we have right now, right? So we will keep improving our order books, and we are comfortable with where we are. I don't think that I would like to increase it, say that, look, I will like to make it 10 to 11, but I think 7 to 9 or 8 to 9 billion every quarter will be a very good number to have.
Are you taking more of these strategic calls where you are being a bit aggressive now because you see the need to replenish the revenue which is going?
Like you said, if we are clear that we'll be able to deliver the margin in those projects for a period of time, we would be interested in taking a look at more innovative ways of doing these projects. Could be aggressive as well, but within the limit. We don't, like you said, for us always the mantra is growth along with margin. But once we are confident that we can make the deal very margin, at least as long as it's not dilutive, we'll go towards it.
Is BSNL a strategic deal? Because the street perception is that it's going to be very dilutive for you.
Absolutely, it's a strategic deal.
But is it margin?
See, one is, the nation needs it. Where else you will get an opportunity to roll out 4G, 5G network, completely modern, totally indigenous. It will create thousands of jobs in India. And the experience of rolling out a modern network, completely software driven, because network so far has been predominantly hardware driven. The first time I think we are all moving to software-defined radios, which essentially means that more and more of software into the network for its reconfiguration, optimization, etc. It's a great opportunity. It's a strategic deal. Whether it is dilutive or not, something that time will say. But what we would learn from it and how do we make it as a portfolio across our client base in both enterprises and telcos alike is the kick in it.
Yeah, that's a strategic nature. Like, you don't look at one deal at a time. What is the value of this deal to us in the big picture, right? Based on our learnings, how many other places will be able to do similar services at a better margin?
Okay, but if you can give some confidence on when revenues start growing, I mean, when do we get back to the 21 or the 22 kind of pace of growth?
Latha, I told you the parameters.
Is it a year away? Are your clients giving you any?
If you can tell us that 24 will be a better economic year, I would say we will grow better. I don't see, even the economists don't seem to be having a good view on how 24 would be or when markets would turn more positive. Once we have a good understanding, we can tell you. Like, if the economists don't know when the market will turn around, how can we tell you?
So just to spin it, so just purely based on the execution of the currently won deals that you have in your portfolio, what is the kind of growth you will be able to clock in FY25? Can it be double digit or high single digits, just purely executing on the deals on hand?
Any which way ask, right? Then answer is same, because we don't know all the parameters. We are, like he said, our planning horizon is 15 days. We want to be close to our customers, relevant to our customers, respond to their needs, and whatever is best for the customers and best for TCS.
Just give me a final headline. This 11 billion deal that you have spoken about, what is causing such a good growth in the deal pipeline? Is it because you are better than others, you're grabbing, or is the pie growing?
Both. Like, definitely we are better than others. Okay. And the pie is also growing, and we are addressing new market spaces which we are not addressing. Like BSN is an example. It's probably a kind of deal we would not have done a few years ago.
All right. Congratulations on that, and let's hope that you will have more certainty when we meet next quarter.
Thank you.
Thank you.
Thank you. Thank you.
Well, we have to take a break on that note. Back to you guys in the studio. back to the TCS top brass. We now have with us the head of HR and the CFO. We have Samir Siksaria and Milind Lukkad with us. Thank you very much, gentlemen. Milind, it has to be an HR question because of this huge 6,300 numbers that your workforce shrunk by. Now, I mean, you shrink the workforce only when you don't see enough work. So can we conclude that Q3 and Q4 perhaps are going to be as tough as Q2?
From a workforce standpoint?
Yeah, otherwise you would have more people, isn't it?
I think I expect, if not to that level, but similar numbers in the coming quarters.
Similar numbers on the headcount reduction?
Yeah, headcount reduction.
Oh, you will reduce 6,000 in the
I will not
current
I will not be able to commit to a number, but yeah, we are in making all the investment which we made in the past is now getting eventually we getting fruits out of it, and as a result we are attrition also is coming down, and as a result we are recalibrating our hiring. So our hiring numbers are going to be less compared to our attrition, and as a result I see the number will be lower significantly. If it is a low positive or a negative number is very difficult to say at this point.
Is it because they're more productive, they're better trained?
Because we have trained them for 18 months, 18 to 24 months. They have gone on the jobs, and now they have come on stream and now delivering. So that actually is a significant investment which we made is now paying off.
So is that a margin lever then, Samir? We should, because of that, is that one reason why you should expect better margins in Q3 and Q4?
So absolutely it's a margin lever, and that's what has been delivered in Q2. So if you look at the key, what we call as disciplined execution, or what we got 100 basis points specifically from driving productivity and utilization. And also being able to replace or further optimize on the subcontractor cost.
Samir, is 25% exit margin for this year a tall task, considering that you will have large deal transition which initially do put pressure on margin, and plus there are fewer working days? So is 25% a tall task according to you?
So I think first we'll be happy with what we were able to deliver in Q2, with top line being slightly sluggish, being able to deliver 110 basis points, and keeping in mind that we have given full cycle increments for the year. I think and the levers which I talked about, if we are able to continue, and they do provide further scope for optimization, that would be what we'll be relying upon as a positive. As you rightly called out, there would be headwinds which we have to take it into our straddle when we are working on the overall.
So 25% doable?
Let's hope.
How much of a headwind are these large deals on your margins?
So like I yesterday also spoke to you, we look at it from a portfolio perspective.
No, just in the near term.
See, overall our objective would be as a portfolio to deliver the margins which we are looking towards.
There is a belief among analysts that in these large deals, since they are so severely competed for, they tend to be of lower margins. Is that a fair assumption?
So as I mentioned yesterday as well, we'll take strategic calls at a specific account level, but overall our focus would be to stay focused on the portfolio delivering the margin. Yes, it could be in some things, and that's our strategic call which we would be taking. Also, the deal life cycle or the project life cycle also could have various varying levels of margins.
So directionally, margins improve in Q3, Q4 versus Q2?
With your best wishes.
Milind, getting back to that point about recalibrating your hiring, you had put out at the beginning of the year that you will hire 40,000 freshers. Does that target stay?
So I think the point is we have made offers, and we are not obviously we are going to honor all the offers, right? And the point is when do they come in, which quarter they come in is something which gets calibrated. So that is how what the plan is. In the past we also hired during the year, that also has happened. So we'll do all kinds of things, to ensure that we are aligned with what is required from a business perspective and what is required from a long-term standpoint.
are training costs going up, Milind, because you'll have to respond to generative AI, new technologies, new challenges?
I think our investment in overall talent development is very, very high. It is a significant.
Does it get higher is what I'm asking.
No, but it is so high that this is not material enough to basically make a significant impact.
Okay. So, Samir, therefore, what will you look for as margins? You clearly told us that one lever is the fact that you're able to do more work with less people. What are the other margins, other levers?
So first, let me tell you, the differentiated margins which we have, or the industry leading margins, are a result of the investments which we make early on in the life cycle. And I think, as I said, the current levers which so productivity, utilization, and if growth continues as it is, then further looking at subcontractor cost would be the key levers. And if I look at it, if growth accelerates, it will only help us accelerate this journey also.
Milind, it's very rare that TCS delays even the onboarding of freshers. It's not happened to TCS in a very, very long time. Isn't that?
See, there are situations which we need to adapt to, and while I'll tell you one thing, even though we have delayed a bit, we have constantly engaged with the freshers and ensuring that they are not just engaging with us but also learning along the way, and so there is a situation where we don't feel that that the aspect of them delaying joining us is letting the engagement coming down. Engagement is continuously on, and this is just a couple of months here and there, so I think we should be okay.
Samir, finally I wanted to ask you, are there green shoots in terms of areas? See, BFSI clearly year-on-year terms is 0.5% down. Likewise, you're down even in some other verticals. But you're doing well in obviously Middle East, you're doing well in energy. What are the green shoots where you think you can compensate for the difficult period that BFSI is going through?
So if you look at, I'll not base it on one quarter, but definitely in Q2, if you look at BFSI has delivered positive growth sequentially versus we know the pain which has been through the many quarters, specifically in BFSI and North America. Similarly on Europe, sequentially it has been a little better. But I think the most impacted verticals have been BFSI, the telcos on CMI and tech and services, and a little bit now coming in on the retail side versus manufacturing as well as on energy and utilities, which we have carved out now, have been outperformers at double digit. From a geography perspective, the emerging markets have outperformed and UK continues to be better.
Okay, but will they be good enough to counter to some extent what you are losing in BFSI?
That's what we have to monitor and balance it off. That's the equation we have to play.
Milind, does attrition get lower from current levels of 14.9%?
I expect it to come down further to our industry benchmark levels, which we are used to, in the 11 to 14% range.
11 to 14%. And this could happen as early as?
As early as next quarter. Yes.
Okay, and for the end of the year, are we actually seeing a single-digit attrition number?
Hard to say. Hard to say. But I think we are okay with 11 to 14% range, and we expect to maintain that.
Okay. Samir, would you say TCS has gotten a bit more aggressive on cost cutting this time? Because despite no growth on your top line, you managed to deliver a very strong margin expansion. I know your peers have embarked on a cost optimization, cost cutting, call it what you want. But is TCS also looking at that?
See, if you look at my commentary with y'all in last quarter, I called out on the discretionary expenses that they have achieved critical mass. And these are something which we were able to deliver significantly. We are called out on the productivity utilization also consistently that we have opportunities to optimize. While we have, if you look at some of the expenses on the direct revenue side, the cost of revenue side, those have continued to increase, and we have invested where it is required. You see infrastructure expenses going up. So
Just a final question from me. We always keep telling you this. Accenture has announced this $200 million generative AI orders. When do we hear the first one from TCS?
see, we have been investing enough. We have had 250 projects which are the pipeline which is available, and we are incrementally working with customers in terms of their pilots, co-innovating with them, and also working with them on their Gen AI strategy and roadmap.
So you may stun us this quarter itself.
Let's see, let's wait.
Right.
Milind, just one more question. You all organized restructuring. There was a change in the way you all structure the organization. It's now decided on geographies, verticals, a bit of a departure from what we've seen in the past few years. What is the change that you expect it should bring about to TCS, the benefit of this organizational restructuring?
It is more aligned to the customer situations. The customers also like it. And we bring in the overall industry point of view, and at one place. All of that is so important, and that will basically only bring us to our customers closer.
Okay. All the very best for the third and the fourth quarters, and thank you very much for participating in this chat.
Thank you, Latha. Thank you, Reema.
Back to you guys in the studio. Okay.